20 stocks that investors hate but Wall Street loves as the S&P 500 nears a record high. This is the piece we are going to cover. We came across this on MarketWatch, so we decided to disclose it to you guys. And we're also going to cover this about the sentiments of Jim Cramer. Jim Cramer, of course, you know, is a host of a popular CNBC show. Says clueless investors just keep driving this stupidly bullish stock market high. And of course, you know, we have this platform, Equity for Keeps. You know, it's a platform that helps you make very clever and smart use of your money. And with this platform, you can ensure that your disposable income, especially the very significant ones, which is mostly rent and mortgages, are also a means of also not just settling the necessities that they settle, but also become an investment opportunity, an opportunity to secure or grow assets for the future. So it simply means when you sign up, when you register here, you come over here and you register. So you indicate who benefited from your payments, like the landlord or the bank, as the case may be. And then we will go and negotiate with them to invest that money you paid them in the equity you obtained when you signed up. You know, so in a nutshell, that's making very clever and smart use of money, paying your rent and also growing your investment for the future. So back to our main issue here, and the author says the rally for U.S. stocks from the March bottom has been remarkable, but most S&P 500 stocks are down for 2020. This year has been adventurous for stocks, with almost a full rebound for the S&P 500 index from the pandemic lows of late March. But the rally has not been as broad as you might think. Below is a list of 20 stocks that are still down at least 20% for 2020, but also have majority buy or equivalent ratings among sell-side analysts. So this is a screenshot of an analyst, and he concludes that March feels like 7 years ago in market cycle terms. So you can see the S&P 500 ETF trust has, or rather, made a V-shaped recovery. This turnaround has been fueled by the tremendous increase in the money supply resulting from the timely action of the Federal Reserve and the federal government. Of course, the U.S. federal government and U.S. Federal Reserve. Very low interest rates play their part. The yield on 10-year U.S. Treasury notes is 0.55%, while the dividend yield for the entire S&P 500 is 1.70%, according to FactSet. So this, in summary, this paragraph is just saying that the lending action of the Federal Reserve and the borrowing action of the federal government, that's the Treasury, the U.S. Treasury, has fueled this market rally. Okay, so and then because the yields on the notes and the debt government, the yield on the Treasury notes and the coupons and the bonds are low, so it makes it imperative that people will invest in equities, on the stock market. And the S&P 500 was up 3.5% with dividends reinvested for 2020 through August 4th. But S&P 500 is weighted by market capitalization and therefore dominated by the FANG, to which we add Microsoft, So you can see why the rally has occurred, because these three stocks, this block of stocks have been doing well since they are weighted by market capitalization, and these ones are doing exceptionally well. You can see Facebook total return for 2020, and we're just in the second half, 22%. Apple's 50%. Amazon, which is the biggest of all of them all, 70%. Netflix, 58%. The two classes of Alphabet, 10% each. Microsoft at 6%. And share of the S&P 500, okay, I think they total to, yes, 25 together. The FANG group plus Microsoft make up to 5% of S&P 500. So the S&P 500 is likely to will be doing well if these the market caps of the FANG stocks keep doing well. So loved by Wall Street. Among the S&P 500, 292 stocks that were down for 2020 with dividends reinvested through August 4th. That may be a big surprise, and it underscores the influence of the big tech names listed above. Among those 292 stocks, 149 were down at least 20%. Here are the 20 stocks among the S&P 500 down at least 20% this year that have the highest percentage by or equivalent ratings among sell-side analysts polled by FactSet. The table is sorted by the percentage of buy ratings, and scroll to the right to see more data. So you can see here, Phillips 66, refining, Pioneer Natural Gas, Diamondback Energy Inc., Oil and Gas, AES Corp, and their return so far you can see here at the same time. Valero Energy, Oil and Refining, Marketing, Concho Resources, Citigroup, down 35% this year alone. Las Vegas Sands, obviously we know because of the COVID, it will definitely be that affected. GM, Baker Hughes, Hartford Financial Services Group, Citizen Financial, Technip, FMC PLC, Marathon PLC Core, Ross Stores Inc., Capital One Financial, Synchrony Financial, Raytheon Technologies, Win Resorts Limited. So we're going to see what else they have here. Share buy ratings. You can see here. See how high the ratings are. Share buy ratings. And then consolidated price targets. Look at the price targets. And then implied 12-month upside. So these are the implied 12-month upside is that they are all now in the positive, going by the ratings of these sell-side analysts. So we just come back to the piece on Jim Cramer, and it says here, is this the dumbest action of the year? Sometimes the market rallies and it makes perfect sense. Then there are days like today when I can't take how stupidly bullish this market can be. That's CNBC's Mad Money host Jim Cramer shaking his head at clueless investors who ignored multiple warning signs to buy up stocks during Tuesday's bullish trading action. Never underestimate the power of enthusiastic buyers who do not know what they are doing, he said, after the Dow Jones Industrial Average finished the session with a triple-digit gain. The S&P 500 and Nasdaq Composite also ended higher. He specifically pointed to oil giant BP and biopharma firm Sorrento as examples. There's plenty of stupidity, he said, especially during the earnings season when there's so much news that it's hard to keep track of what's going on. BP's surge, in particular, didn't sit right with Cramer, who said it might be the dumbest action so far this year. Not only are they telling you business is terrible, BP is trying to distance itself from crude while preserving cash, but maybe that dividend hike was a mistake, he said. In Sorrento's case, Cramer pointed out the stock barely rallied last week when the company announced a new saliva-based COVID-19 test that yields results within half an hour. But then on Tuesday, the stock surged for the same reason. The stock market's supposed to be efficient, he said. But somehow, it took Wall Street 6 days to process this news. Okay, he says, watch this clip. Are we going to play the clip? No. We will include a link for you to play and see for yourself. As of Wednesday's session, more stability. The Dow was up more than 300 points at last check, while the S&P and Nasdaq were adding to recent gains as well. Are any of these moves the fault of the Fed? Cramer wrote in a separate take. No, the fault, as Cassius tells us, is not in our stars like Trump or Powell, but in the buyers themselves. Okay. Let's play the piece a bit. Is it gonna play? Buffering. Okay, we will include this link. You see it right at the bottom of the in the description page, and you can play it yourself and see what he's saying here. There. Okay. Don't forget to sign up on our platform, Equity for Keeps, and also don't forget to subscribe if you haven't subscribed. Subscribe, hit the notification bell, and let's get going. Thank you very much again.